Welcome to Dividend Fortress. The concept of receiving a steady stream of passive income from solid companies is the cornerstone of many long-term financial plans. It sounds ideal. However, this appeal hides a significant risk, one that becomes very real when economic recessions loom. A recession can erode corporate profits, squeeze cash flow, and force management to make a difficult choice, to cut or even eliminate your dividend payments. This is precisely why stress testing your dividend portfolio is not a choice, but a necessity. A stress test is a proactive process. It's designed to identify which stocks in your portfolio are most vulnerable to an economic shock. Think of it as an engineer testing the foundation of a building before a storm arrives. The goal is not to incite panic, but to understand your portfolio's weak points and strengthen them before it's too late. So, why is this process so critical for a dividend investor? The first reason is income security. If you depend on dividend income to cover living expenses, a dividend cut can be devastating to your financial stability. A proper stress test helps you predict which of your holdings are most likely to cut their dividends, allowing you to adjust your strategy and protect your essential cash flow before the damage is done. The second reason is capital preservation. An announcement of a dividend cut is almost always followed by a significant drop in the company's stock price. By identifying this risk early, you can protect your invested capital from substantial losses. Finally, stress testing transforms you from a reactive investor, surprised by bad news, into a proactive one who makes decisions based on data and analysis, not fear and emotion. An effective stress test is built on fundamental analysis. Let's begin with the most basic metric, the dividend payout ratio. This is calculated by dividing the annual dividend per share by the company's earnings per share, or EPS. This ratio tells you exactly what percentage of a company's net profit is being paid out to shareholders as dividends. It's the first and most direct indicator of dividend sustainability. So, what does the payout ratio tell us? Generally, a ratio below 60% is considered healthy. It provides the company with a sufficient cushion if its profits decline. A ratio between 60% and 80% requires closer monitoring. However, a ratio above 80%, or especially one over 100%, is a major red flag. It means the company is paying out more in dividends than it earns, a situation that is fundamentally unsustainable and at high risk of a cut during a crisis. While earnings are important, they can be manipulated through accounting practices. Cash is king. Dividends are paid from cash, not from accounting profits. Therefore, it is critical to analyze a company's free cash flow, or FCF. This is the cash left over after a company funds its operations and capital expenditures. A high free cash flow payout ratio indicates that nearly all available cash is being used for dividends, leaving little room to navigate difficult times. Next, we examine debt. A company with a large debt burden is extremely vulnerable during a recession. As revenue falls, the obligation to pay interest on its debt remains, which can suffocate cash flow. Key metrics to watch are the debt-to-equity ratio, which shows reliance on borrowed money, and the interest coverage ratio, which measures the ability to pay interest from operating profits. A high debt load and low interest coverage are signs of significant financial risk. Beyond the numbers, a stress test requires qualitative analysis. You must ask, is this company's product or service something people still need even when they have to tighten their belts? This is the test of business model resilience. A company that provides an essential good or service has a much higher probability of maintaining its financial health and its dividend through an economic downturn compared to one that sells discretionary or luxury items. This leads us to the concept of defensive versus cyclical sectors. Defensive sectors are more resistant to recessions. These include consumer staples, such as food and soap producers, utilities that provide electricity and water, and healthcare companies. In contrast, cyclical sectors like automotive, tourism, luxury goods, and property are highly sensitive to the economic cycle and are typically hit hardest when a recession strikes. Understanding where your companies sit is crucial. Now let's move from theory to action. Step 1 of the practical stress test is inventory and data collection. You cannot analyze what you don't track. Create a simple spreadsheet listing all your dividend-paying stocks. Make columns for the stock name, its industry sector, and the key financial metrics we've discussed, such as payout ratio and debt to equity. This organized list will be your command center for the entire analysis. Where do you find this financial data? Your primary source should be the company's own investor relations website. Here, you can find official quarterly and annual reports containing the income statement, balance sheet, and cash flow statement. For easier access to summarized data, reliable financial portals like Yahoo Finance or a local equivalent like RTI Business are excellent resources. Simply search for the stock ticker and navigate to the Financials or Statistics section. Step 2 is the individual analysis. For each stock in your spreadsheet, you will now calculate and record the key metrics. Calculate the payout ratio using the annual dividend per share and the trailing 12-month earnings per share. Evaluate its free cash flow relative to. Step 3 is the core of the stress test, applying a hypothetical recession scenario. Ask yourself, if this company's revenue dropped by 20%, a reasonable figure in a severe recession, would it still be profitable? Look at the income statement, reduce the revenue figure, and see if the net income remains positive. If the company swings to a loss under this pressure, its ability to pay the dividend is severely threatened. For an even more realistic test, analyze historical performance. Investigate how the company performed during the last major crises, such as the 2008 global financial crisis or the 2020 pandemic. Did it cut, suspend, or continue to raise its dividend? Did its stock price fall more than the broader market? A company that successfully maintained its dividend through past turmoil likely has a resilient and proven business model. With your analysis complete, step 4 is to categorize each stock. The first category is the fortress. These are the pillars of your portfolio. They are characterized by a low payout ratio, a strong balance sheet with low debt, a defensive business model, and a track record of maintaining their dividend during past crises. These are the companies you can rely on. The second category is the watch list. These stocks are not immediate red flags, but they carry a higher degree of uncertainty. They might have a moderate payout ratio between 60% and 80%, a medium debt load, or operate in a slightly cyclical sector. There is no need to panic and sell these, but they require close monitoring. Pay careful attention to their next quarterly earnings reports. The final category is high risk. These are the weak points in your portfolio's foundation. These companies exhibit clear warning signs: a very high or negative payout ratio, a heavy debt load, a highly cyclical business model, or a history of cutting dividends during downturns. These stocks require your immediate and serious consideration for action. Now we translate analysis into action. For your fortress stocks, the strategy is to hold and even consider adding to your position. When a market panic brings down the price of these quality companies, it's an opportunity to buy. For watchlist stocks, the action is to monitor them closely. If a position has grown too large, consider trimming a small portion to reduce risk without exiting the position entirely. For your high-risk stocks, you must consider the difficult but often necessary decision to sell. Holding on to a stock with weak fundamentals through a recession is a gamble. Ask yourself, is it better to hope for the best or to sell and reallocate that capital to a safer fortress stock? Selling a losing position is never pleasant, but it is a critical part of risk management to protect your capital from even greater losses. Finally, adopt a long-term mindset. The goal of this exercise isn't to time the market. It's to ensure your portfolio is prepared whenever a recession arrives. Use the cash from selling high-risk stocks to rebalance into quality and diversify across defensive sectors. Focus on your primary goal, the steady flow of income from quality companies. This proactive approach builds a resilient portfolio that provides not just income, but peace of mind.